Good morning, traders. This is Brad Matheny. Today is March 11th, Saturday. It's early in the morning, and let's get started with this custom index video. Boy, what an exciting week. I mean, I don't know how to say it, but I do need to warn you that now is the time to prepare for what is coming. As I've been telling you for the past 2 years since COVID hit and even before, I have been warning that the next 7 to 8 years are going to be incredible for skilled investors learning to manage and protect capital through these big trends. The Silicon Valley Bank issue that hit over the last couple of days sent the financial markets reeling. It looks like this is going to be a somewhat orderly and isolated event. There will be fallout, I should state. There will be isolated issues of companies that cannot deal with the lockout of the bank, their assets being locked out. This looks like it was a gross mismanagement of risks related to Silicon Valley assets, and it looks like it may end up being somewhat isolated and somewhat orderly. In the gross scope of things, it's just one bank. Now, it may be a fairly entrenched bank in a highly technological field with a lot of venture capitalists or what have you, but my estimation is that somebody will come in and pick this up for maybe, 100 billion or 50 billion or something, come in and shore up the books, save everybody in the process, and this is probably the start of what may be an extended type of domino effect related to financial institutions with regards to unwinding risk. Now, I need to remind you, please come to my website, MENT.com. What do? I help you stay ahead of these big market trends. Remember, my rotational modeling system moved us away from risk back in February 24th. We were fully prepared for this. We actually profited from this downside move if you've been following my research, and we are effectively hedged in cash and metals and waiting for the next opportunity, which based on my research looks like it'll be June or July for a big trend, possibly to the upside. So the next 3 or 4 months could get very, very volatile. And as I've been warning you, we've been having, we have literally about a 14-15% range in the SPY that we're likely to stay within as this unwinding takes place. So now, obviously, if we break down to the downside, I'll let you know. We don't look like we've gotten there yet. Come join my Expert Growth membership. Follow along. Pay attention to what we're doing. And we'll try to keep you abreast of what's happening right now. Let's take a look at some of the custom index charts as we get into this. This is the accumulation phase index. So the weakness we saw last week in the SPY, you can see up here, this is a monthly chart, but this black bar shows us just how much real selling pressure took place last month. I mean, overall, this is a very small start to a March. We'll see what happens in March. We're still in a moderate uptrend. We haven't seen any big breakdowns yet, and we haven't seen anything really break over here with regards to the accumulation phase index. As I've been telling you, we need to see this stay down in this lower channel and move downward to see any real upward price appreciation. We may get some volatility over the next 60, 90 days leading into June. But right now, we do not have any massive containment or contagion type of event unfolding. The cash flow index moved down, which is to be expected. I'd been warning that we could move down off of these extreme levels. This is really an extreme level up here, ladies and gentlemen. So we need to potentially see movement in this area, staying kind of in this area, which is where we're at. I would highlight that, if you draw a line kind of across these lows, coming across these lows, coming across these lows, you're going to see that we're very close to, early contagion, COVID levels, the election levels. This is a very moderate support area here. to see the markets possibly revert back to the upside over the next 7 to 10 days. So be aware that this could be just kind of a blip on the financial environment as we're heading into the end of Q1. Financial markets may, see some pressure because of what's taking place here. But I believe that the rest of the economy in the U.S. economy is still rather strong. This is possibly an isolated event with Silicon Valley Bank, just due to mismanagement of risks. So now we move on to the next, the Custom Consumer Engagement Index. We had seen it pull back up in, this is monthly, pull back up in February, back up near highs, pulling back down. We could see it move back down into these lows, but we're getting a pretty solid basing bottoming formation here. We might see this move a little bit lower over the next 5-10 days before possibly attempting to move to the upside. It's really just stalling out here, which is why I believe June and July are the critical months for real opportunity. Let this flag out. We have March, April, May, June. We have about another 3 months to go, and then I believe we'll be basing bottoming somewhere back over in here, and then looking for a real upside move, is my opinion. Large cap index moving higher again. This is good to see. Large caps typically will lead us out of a consolidation phase. And so this upward move here suggests that we might be seeing a real early stage recovery in the U.S. economy. You can see after 2008-9, we had a big move in large caps, continued to rally up until 2013 when the Fed was dealing with a lack of QE. And then we had the same scenario here in 2015-16 with a presidential election. And then we had another area here in 2018, 19, 20 before COVID. Then you can see we saw this big rally phase in large caps in the speculation phase. Now we've come back down fairly strongly, and we're starting to see some real support build up. You see the stochastics or RSI is hooked up, and stochastics have hooked up off of this low. This could be a very early stage recovery. It's not telling you to jump into large caps right now. We'll still have volatility. I'm thinking, like I said, May, June, more than likely June, July, we're going to get a good solid basing bottoming and then some sort of an upside market move. Global asset index is starting to look the same way. Got three nice upward candles. We're getting the same type of hook. This is one is U.S. large cap, one is global asset. This is global asset. So we're starting to see some basing bottoming, which is why I think this banking issue is kind of isolated. It's kind of like, think of it as regional. Yes, it's probably going to hurt some things, but it's regional. Okay, gold cycle phase index. So we're actually seeing more accumulation as gold starts to move higher. This is very solid for gold, ladies and gentlemen, just like after 2000, after COVID right here. This is the COVID area right here, this spike. This could be a very solid contagion type of a bottom setting up with regard to this financial unwinding. It may change things over the next 6-7 months. It may change expectations. It may accelerate some of the unwinding processes. It may move metals substantially higher as fear starts to settle in and gold becomes the safe haven that it always does. So be aware that this is a very solid accumulation phase for gold. As I've been warning you, this is a great time to be a gold accumulator, particularly physical assets that you can get your hands on. Understand that we are now seeing more accumulation here. This is a monthly chart. I would not be surprised to see this move back up into the 40 area, 39, 40, 41, back up into this area on strong accumulation through the end of March. The innovation index has collapsed downward. I do expect the innovation index to settle probably down maybe another 8-10%. This is telling you that the innovation index will more than likely settle down and start to recouple to previous trending. You see this previous trending here in this upper two quadrants. That's where I believe we're going to settle. down here in this upper 2 quadrant and continue to base on out of this. This is a weekly chart, so understand that we likely have another 6 to 8 weeks of basing and settling sideways type flagging as we move into May and June. The custom fear index moved up to 8.75. This is a fairly heightened potential fear level, not excessive. I do expect it to settle back down over the next 2 or 3 weeks. You can see the SPY here has moved downward. It's not excessive. We could get a retest of these lows. We could get a break of these lows if the contagion continues. We'll have to see how it plays out. Remember, we're already properly hedged with the MENT rotational modeling system. And regarding the sentiment index, pay attention to the fact that through moderate uptrends, we get this rally phase and then a little blip. Rally phase, blip, rally phase, blip, rally phase, blip, rally phase, blip. Same thing here. Rally phase, blip, rally phase, blip, rally phase, blip. We could be in that mode right over here. Rally phase, blip, rally phase, blip, rally phase, blip, rally phase, blip. I believe that's where we're at in the market. I believe the unwinding has already, substantially unwound probably 70, 80% of the risks in the market. And now we're going to have isolated potential sector risks taking place, which means that the next 3 or 4 months, expect some volatility, sideways trending, trying to hold above this critical low in the SPY, and possibly moving into this kind of a sideways rally phase blip, rally phase blip, rally phase blip until we get into some real accumulation mode. You can see how much the SPY rallied through this period of this rally phase blip mode, and then we ended up into a kind of an excessive rally mode. Same kind of thing happened here. It based and bottomed after the 2018 low, and then moved into a really strong rally phase before COVID. We're doing the same thing, ladies and gentlemen. We're basing, bottoming, kind of like seeking out a base, seeking out a base momentum level. We do still have downside risks. Don't take it the wrong way, but I believe we're actively seeking out a bottom. Custom real estate index moved downward last week. This is really the highest level, as I've been telling you, I've ever seen on this chart. We do need to see this move back down into these lower green areas here. Call it 270 to 300. Call it 260 to 300. And I believe house prices will start to collapse. This is the extended unwinding phase. Could take another 2, possibly 3 years. So be aware that an orderly unwinding would be the unwinding of excess property demand as real estate investors come to terms with a constricting market, trying to get out of excesses, especially if they're not pulling, so to say, their weight efficiently. But again, we've never seen anything like this. The Fed is going to stay aggressive in trying to manage and deflate the market. And I believe this is just waiting for a downward cycle phase right now. Possibly something more along the lines like this. Possibly more along the lines of this or this, where we get into a downward cycle and it takes 2, 3, 4 years to potentially base and bottom before we get into another appreciation cycle. This would indicate, as you're seeing here, an extended downward cycle in pricing. An extended downward cycle in pricing where we see very little appreciation. We will see price depreciation. I do expect pricing to come back down into this 320 or lower area on some sort of an excess phase collapse, so to say, of speculative bubble pricing. But once we get down into this 300, 320, maybe 280, 270 area, then we're going to see this basing setup. We're going to see these lower channels come into play with some real basing taking place and moving back to the normal, 1.5%, 2.5% growth per year type mode. But in order to do that, we've got to get out of these excesses. We've got a lot of people who are heavily invested in real estate as a speculative form of investing, and that unwinding is likely to take place over the next 3 to 5 years. Next, we have the tech ratio index. Tech ratio is holding up quite well. Good solid basing and bottoming. This is a monthly chart, so we're looking at March over here, February, January. This is showing us again that the markets are attempting to hammer out a bottom after a very broad unwinding phase. This could still take 2, 3, 4 months to settle and form a bottom. But remember, this is a good sign that we're looking to actively hammer out a bottom, folks. The U.S. to global market weekly chart index, you can see the U.S. market tanked compared to the global market. Global market did not have the same type of effect downward as the U.S. market. Still needing to hammer out this bottom. That's, again, the message I'm going to be showing you is that we've established these lows. We've come off of these lows. We had a fairly good start in early 2023. Now we have a little bit of a financial contagion issue with regards to the Fed. My bet is the Fed's going to start to become more malleable, more adaptive to what's actually going on in the economy and attempt to contain some of these fallout risks that are taking place. The U.S. market could still move down into a lower channel, trying to retouch these COVID highs. I know that in a lot of sectors we're already below some of them, but with regards to this index, we could see the U.S. market enter into some sort of a capitulation bottom, which could set up off of some unorderly, chaotic unraveling of excesses. I don't believe it's very likely right now, but it could still happen. With the global market, what would happen if the U.S. market fell again is the global market would more than likely fall as well. Again, the U.S. market drives almost all global market activity. So be aware of the fact that if the U.S. market moves into a downward cycle, we need to be very aware of potential downside risks. But we are likely hammering out a bottom still. Until we get any real clear evidence of extreme price weakness, we are trying to hammer out a bottom. Okay, this is again one of my favorite charts, the U.S. Valuations Index. Notice the little white bar over here. This is March. We are getting into potential strength taking place in the underlying U.S. valuations. So we've got a good solid base. We've been holding this base level for about 6 months. We are trying to form a base and a bottom. We'll see what happens through March. If we can get a little bit of an upside move, a little reversion back to the upside, it would be very interesting to see this potentially turn into like an engulfing pattern or a thrusting pattern, kind of like this, or even an early stage pattern like this, where we may see it really trying to form and hammer out a base bottom. You see the RSI is extremely undervalued and the stochastics are already very, very low. Could we move lower? You bet we could. I mean, there's nothing saying that we couldn't under some disorderly unwinding phase, but as of right now, I'm still believing that we are in a orderly unwinding process, and the independent bank issue, Silicon Valley Bank, is just isolated contagion risk. Okay, the leading index is holding up in this upper channel, very solid. I do believe we could come down into this area or slightly below on some sort of a contagion pullback. When I say that, I mean that, this would likely be some sort of a blip, kind of like we saw possibly back over here or back over here. And I believe that we're, like I said, we've unwound quite a bit of the excesses. So unless we see some sort of a real crisis mode, I believe we are just struggling to unwind further excesses while we're attempting to hammer out a bottom. So likely to stay above this 180 area, trying to just blip sideways. And remember, as we blip sideways over here, this was a fairly solid rally phase. This was the excess bubble. So we need to stay away from these excess areas, this upper white area. So pay attention. When we get into these excess areas, we're probably going to start seeing some sort of a pullback, reestablishing the base and bottom, and move into a sideways channeling mode in this 180, 190, 2.0 area here. Volume ratio index really collapsed last week. Now, this is concerning because we could get this type of a blip mode changing the trend. So understand that we do not want to see this type of a trend simply because this could change the trend into a downward cycle trend very quickly. So we need to see this attempt to rebound, see what happens next week. We are seeing fear drive the market, which is evident in gold. Commodity gold index collapsed back down into the red area. This is perfect. We do not want to see a super heated inflationary trend. We want to see everything continue to unwind more efficiently over the next 6 to 12 months as we move into 2024. 2023 and 2024 are going to be very difficult for traders, like I've been saying. It's not going to be easy. This is where you need to stay actively aware and protect your capital. But unwinding of assets and inflationary trends continues to stay in place as we see this downward trending, which is actually good to see. Custom metals index, as I mentioned to you, I'd gotten up to this point. I started telling you gold was going to pull back, carried up a bit further, and then pulled back here. I mentioned to you a couple of weeks ago that this 50% level looked very solid for support, and look at where we're at right now, continuing to trend higher. I believe gold is on its way to 2150, maybe 2250 right now on this fear cycle. So be aware that now this is a very good time to be hedged in metals if you've been listening to me, and we will see what happens as we continue to move forward. The FANGs index is still kind of trending sideways in a normalized channel. This is a good basing and bottoming. Like I said, I don't know why these things are black. It must be something related to data from TradingView. It all started right around the end of last year. And this is likely due to the fact that, certain data is still moving in a downward cycle. But again, ladies and gentlemen, holding up, look at this arcing pattern here. So you've got a very solid arcing base. This is what I would call a momentum base. It's come down, it's stalled, it's rolled through for almost a year and starting to roll back to the upside. Could we get some downside blips? You bet we could. But it's really starting to base after this broad unwinding cycle. Custom metals index, this is more tied to gold than the metals trend index of earlier. You can see we've got the pullback. We're starting to move higher. I think that the next 2 weeks could be very explosive for gold. I think we're kind of like in this COVID collapse right here. It's just kind of what happened over this period and where we're at right now. And now we've seen this recovery phase where we could see 3, 4, 5 weeks of fairly strong recovery back up into 2000, 2080 maybe for gold. The long and short of it, ladies and gentlemen, though, is that this could be very explosive for metals. Gold and silver could see a nice solid rally back up to all-time highs and then attempt to move even higher. Smart cash index, this is the global smart cash index, is seeing weakness. We're still trying to hold near this previous gapping level, which is acting as a support level. We are seeing some general weakness. Now, again, the issue is on the U.S. right now, not the global markets. Although I'll bet global markets are still reeling from the unwinding cycle phase. So we need to see what happens next. Do we get a further unwinding, or do we get that momentum recovery over the next 3, 4 weeks? Time will tell. Okay, the MENT rotational modeling system had moved to bearish on February 24th. We are still bearish. We're 50% bearish SPY, 50% cash. We got 2.61% profit in this new bearish trade. I've added some new symbols here. US real estate, retail, and the financial sector are both bearish. Had some change in trending. See, the daily is all bearish. This is indicating that we're in a pullback in some moderate consolidation. We moved our allocation levels on February 24th to protect capital more efficiently. If you had followed these signals and the MENT rotational modeling system trading signal, you would have been well prepared for this little downside move. And like I said, this is updated as of the end of February, and I will be updating it here closer to the end of March to show you what we're doing. We're likely moving to new all-time highs over the next 6 or 7 months with this, folks. So be aware that this is going to continue to perform very well. All right, real estate is starting to pull back a bit. I believe this is essentially a change in dynamics. I believe that we've reverted back out here for price and demand. I believe that the overall market dynamics are very weak. As you can see, reductions are at 150%. Active real estate listings have contracted again. Listing counts, this is a new listing count. We've seen a lot of listings come on the market, but you can see that things are just not moving. Next, we have the tightness index is down at minus 80%. Real estate inventory strength is at minus 4%. Heat rank is at minus 1%. And seller desperation had blipped over the past 2 weeks. It looks like we're getting into some sort of a real estate down cycle here. US stock market index weekly. This is more tied to the SPY and the NASDAQ. You can see we've had a fairly strong pullback. This is an indication off of this low here, folks, that we could be very close to establishing possibly an A, B, C move, coming down here, maybe moving back down into this 1,000 area for support. We need to see how it plays out, but this looks like a wave B pullback, looking for support before it attempts to move higher. Custom valuations chart is staying in the red area. This is great to see. This means we're seeing further unwinding of inflationary trend, which is ideally what we want. Volatility index, as I'd mentioned to you, had come down excessively. I kind of warned of this last week when we were back up here. I indicated that we could see it move a little bit higher, but ideally we're going to see some sort of a pullback like we saw back over in this trending mode. This is our pullback. So now once we see this pullback off of this low, we could see a recovery mode back up into 10 or 11, which would be upward trending. And then possibly for a couple of weeks, maybe see moderate upward trending and then another pullback. This is kind of like that rally blip, rally blip, rally blip, rally blip mode, which took place throughout all of 2020 and most of 2021. That indicated a very strong upward trend. Okay. That's it for now. So now let's come back over here. Let's take a look at the SPY. And I have a weekly chart here. You can see the SPY trend last week was very strong to the downside. We're still in this upward channel. So if we recover from these lows right here, folks, move back up into this upward channel, there's a very good chance this could be kind of a washout, contagious, or let's call it chaotic bottom on this Silicon Valley Bank financials route. I believe that's what's likely going to happen. I believe it's going to be an isolated incident. By next week or so, we'll find out that there's some proper resolution in place and the markets will resume their bottoming mode, their extended momentum basing. And when I say extended momentum basing, meaning that we're going to see a potential rally up in the 420, 425 area, coming into end of March and April, and then rolling over into a consolidation phase. I'm still holding on to that analysis because we haven't seen anything to indicate some broader contagion event. The Fed may become more adaptive. The Fed will likely become more adaptive and start talking about, their plans regarding managing the unwinding of crises, and ensuring bank stability. So be aware that that's going to probably be the discussion over the next couple of months as they continue to try to unwind inflation. Follow my research, guys. Come join me over here. Try to pay attention to the research I'm giving you and follow the signals that are being generated along with all of the research that I do for you every week. The MENT rotational modeling system should be your primary focus as we try to protect and manage capital over the next 7 years. Thank you, guys. Talk soon.